On January 23, 2019, Ford Motor Company reported fourth quarter and full year financial results for the period ending December 31st, 2018. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about Ford's business model. Ford was first incorporated in 1903 and has grown to become one of the world's largest automakers, along with the manufacturing, distribution, and sales of its popular assortment of cars, trucks, and SUVs. Ford also operates a large financing business. Ford trades on the New York Stock Exchange with a market capitalization of $35 billion. The company has annual revenues of $145 billion. Ford may not be a well-known dividend-paying stock, but it offers a very high yield of 6.8%. With that said, Ford is not a consistent dividend growth stock. The company eliminated its dividend in 2006 and did not reinstate it until 2012, which excludes it from being included in a dividend growth database like the Dividend Aristocrats. Ford has paid the same quarterly dividend since 2015. Looking ahead, investors interested in owning Ford stock will be interested in the safety of its current dividend payment. For the remainder of this video, we will discuss Ford's dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Ford's dividend safety in the context of the company's current earnings. In the fourth quarter of fiscal 2018, Ford generated earnings per share of 30 cents, which compared favorably to the 39 cents of earnings per share in the same period a year ago. For context, Ford currently pays a quarterly dividend of 15 cents per share, which implies a payout ratio of 50% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Ford generated $1.30 of earnings per share in fiscal 2018. The company distributed 60 cents of common share dividends during the same time period for a dividend payout ratio of 46% in the full fiscal year. Using earnings, Ford dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Ford's current dividend payment to its free cash flow. Ford generated $1.36 billion of cash flow from operating activities in the fourth quarter of fiscal 2018 and spent $2.12 billion on capital expenditures during the same time period for a negative free cash flow of $760 million. The company's free cash flow did not cover its $1.1 billion in distributed dividends. Looking out over a longer time horizon, Ford has performed much better in this area. Ford generated $15 billion of cash flow from operating activities in fiscal 2018 and spent $7.8 billion on capital expenditures for free cash flow of $7.2 billion. The company distributed $2.9 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 40%. Using free cash flow results for the year, our conclusion for Ford's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Ford's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Ford's performance during this time period is shown here. Ford's adjusted earnings per share declined to zero from 2008 to 2009. The company has still not regained its pre-crisis high for adjusted earnings per share. The company was forced to cut its dividend in 2006. Because of this, we have serious concerns about its ability to maintain its dividend during future economic downturns. The last angle we will use to assess Ford's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of fiscal 2018, Ford had $14.1 billion of total debt outstanding. The company generated $1.2 billion in interest expense during the year for a weighted average interest rate of 8.7%. The following image shows how changes to Ford's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Ford's weighted average interest rate would need to rise to approximately the 40% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Ford's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on Ford's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.